Hi, it's Michael Glennon, and welcome to our quarterly webinar for the quarter ending December. All right, so just get rid of that. So I'll just give a bit of a review of what happened last quarter. So this is just a chart of the ASX 200 versus the small ords. So you can see for up until December, the large caps outperformed the small caps, and then just towards the end of the year, the large caps were sold off and small caps rallied into the end of the December month. And then if we have a look, just talk a bit about what our strategy was over the last quarter. Most of you who will have been looking at our NTA updates will have seen that we had high levels of cash. We waited for value. We felt, as we did for most of last year, that a lot of the market was overpriced and incredibly expensive. Earlier in the year, we had exited from a lot of the high PE stocks. And I guess to sort of summarize how we viewed the market over the last 12 months, it was more about because we did have concerns about valuations and the domestic economy. If you make an analogy to cricket, we tried to hit singles rather than trying to take big positions and hit sixes. So, with a fair bit of cash, we still managed to outperform for the quarter, albeit only marginally, but with a lot of cash, that was quite a good outcome in a rising market. Just turning the actual performance numbers, you can see we underperformed in October, but in November and December, we had some outperformance for the portfolio. So we are starting to recoup, some of that underperformance that we had, and the portfolio is continuing to perform well. We move forward now and just look at how our cash was over the year. You can see, the cash got up at one point in time to about 50%, in August and September. And we went out and we saw a lot of companies and started to see a lot of value in the market. Unfortunately, at the moment, value stocks aren't really being valued by investors. A lot of people are still happy to play that momentum game, jump on board expensive stocks with high PEs that don't make a lot of money. And if people recall from the AGM, I put that slide up, and you can go back and have a look at that about, the actual cash earnings of the businesses that we have in the portfolio versus that basket of WAC stocks. Our portfolio valuation is about 1/10 of the value of those expensive stocks, and it's supported by the same level of cash flow. So I'm comfortable with that position. And I think that, a lot of those high PE stocks or stocks without any PE will really start to struggle at some point in time when they need cash. They can't continually go on and raise capital to support their growth because they don't have sufficient cash flow to do that. So, but as you'll see, the cash has come down quite significantly. To early January, the cash was in the single digits. We have realized some investments, so that has increased a little bit since the end of the year, but we haven't had too many problems finding stocks to buy in the last couple of months. So if you have a look over the last quarter, these are the stocks that added and detracted the most value from the portfolio. I'll go through each of these in a couple of minutes, but you can see Resimac, Wagners and Hills all contributed significantly. And Mosaic Brands, which is the old NONI-B, was the largest detractor of value during that period. So we just talk about Resimac for those of you that don't know. Resimac is a mortgage business, so it lends to consumers, mainly house loans, and the attraction of a business like Resimac. I'll just move forward to the share price. You can see it's had quite a strong run. So when we started buying the shares, it was about $1, and it was on a PE of about 8 when we bought the business. But what Resimac's benefiting from is the fact that spreads in the wholesale market have contracted, so their funding costs are a lot lower, so their net interest margin, the difference between what they pay and what they charge out, has actually expanded. So, these are our numbers on the business. It's still only trading, on a PE of a bit over 10 times FY22. These are consensus numbers. These aren't ours. We've got a little bit more optimistic forecast for that business, and we think over time that business will double. They're performing very well. They've made some small acquisitions. Every time they make an acquisition of a loan book, they get that instant uplift from the fact that they can put their funding into that business that they've bought, which is at significantly lower rates. Last year they did 3 capital raises, the last one being a wholesale bond. They raised $1 billion towards the end of the year at very attractive rates. So the more they keep, the bigger they get, the tighter that spread they pay on their debt is, and the bigger their interest margin gets. So we're quite optimistic about that. They've got good organic growth, and we think there'll be upside surprises in Resimac. So we continue to hold those shares. The shares have appreciated from where we started buying them, around the dollar mark up to sort of, $1.42 at the moment. Wagner's another business we've entered into in the last 6 months. Wagner's has got some very positive tailwinds behind it. So while it looks expensive from a PE perspective, it's got long-term contracts with its clients. Wagner's provides quarrying services, cement products and things like that for infrastructure projects. They do work offshore. They're on the cusp of getting in the final stages of negotiating contract in Mozambique. They've got a big contract for Brisbane Cross City Rail project, which is a large thing. They're doing works for Adani, and these are all several-year projects. And so the company, it was an opportune time for us to buy. If you look at the share price chart there, it's come down a long way. Had some issues. They sold a business to Boral. They're in court with that. Outcome from that's expected to come, any day now. I think it was heard, early last week, that case. It's still ongoing. But look, we're expecting, more infrastructure works. There's a lot of concrete works in there. They've got an Enviro concrete product, which is getting good traction in the market. So we think, the business has been oversold and it's got good upside here in terms of getting, long to medium term contracts for infrastructure spend. It's got opportunities offshore. I mean, the Mozambique contract is worth, I think it's $120 million over 5 years. So it's quite significant. So that's another one of our larger positions at the moment, which we did well out of last quarter. It has come back a little bit this quarter, but we're still optimistic about the business. Hills, I won't go into too much detail on Hills. We've been talking about, I think we've held the position for about a year now. And if you look at these numbers, it doesn't look all that attractive on a headline basis, but that's where, getting out and seeing the businesses and talking to management and going through the actual individual components of each business benefits you as an investor. We started buying the shares around 14 cents, which was their sort of low. It doesn't come up that well on this chart here. So the company's been re-rated significantly on the back of, they have a medical business within this business. There's a lot more detail we wrote up in our newsletter, and there's details on our website on it, but really the medical business, which produces about $11 million EBITDA or $40 million revenue, is the gem within this business. And it sort of justifies the whole market cap of this business. It's growing quite strongly. It's got a very strong position in public hospitals. 43% of all public hospital beds have the Hills healthcare system in it. If you have a look at the numbers here, you'll see, from FY19 down to FY22, revenues going backwards, but they're benefiting from the fact that they're selling off some of their old distribution businesses in the electrical field. They've sold the audio business to another listed company. So as they get smaller, more focused, we think management will get more time. They've got about $180 million revenue from the distribution business that doesn't make money at the moment. We think that they'll get at $180 million, they only have to get a couple of % margin out of that business to have significant growth. We're less optimistic about the timeframes and what management are about getting that margin, because we think it'll be very difficult. But now that management's focused, they don't have the audio business anymore. Distribution business is smaller, and they are look at selling businesses off. They pay off debt. You also get that leverage in terms of less interest costs as they pay down debt. So we think there's still upside within the Hills business, and we think longer term, after speaking to management, that this will eventually become a pure play medical business, which should attract a market cap higher than $100 million. If you do want more information, I think we've got a video out on YouTube, and there is a write-up on our website on the blog section. That's just the share price chart of Hills. So new things that we've bought in the portfolio. We've bought a business called Probiotech. So Probiotech's it's a contract manufacturer of over-the-counter pharmaceutical products. So it's been very good at changing its business over the last few years. It used to be a big producer of lactoferrin, which is whey powder. They've moved that business now, and what they do is they produce low-grade pharmaceuticals. So they're not producing the heavily restricted type of things, but what they are quite good at is they own a lot of the IP about how to formulate these products and combine them into a pill or whatever it might be. The contracts are all long term. They haven't lost a major client in 5 years, and they have blue chip multinationals as clients, companies like Pfizer and Procter and Johnson & Johnson, to name a few. So they're winning contracts. They're able to buy businesses incredibly cheaply. They just bought a blister pack company, which they paid about two times EBITDA. They're expanding their warehouse, so we think management's doing an excellent job of using capital efficiently, selling off businesses that don't have much growth in them, buying complementary businesses where they can get efficiencies out of using their manufacturing. They're really buying customers in this case, and once a multinational is signed up to get them to produce, whether it's paracetamol or something like that, that customer stays for many years with them. And as I said, they haven't lost a customer in 5 years. So they're doing a good job. Shares have been, moved forward a little bit, re-rated slightly. We started buying the shares, around $2. They've moved up, since then. We're still happy with the investment. We think management will do a good job going forward. So if we move forward onto Brickworks, Brickworks is another stock we wrote about in our newsletter a couple of weeks ago. Brickworks is not so much, as the name implies, solely a brick manufacturer. It's got several different divisions within it. It's got quite a large property business. Management's been good at turning. Lindsay Partridge, who runs the business, I think he's been there at least 20 years. I think long-term history in the brick industry. So if you just look at the Australian business, they've got a dominant market share in Australia. They've been very successful in turning old brick pits into property developments, holding those property developments. They joint venture with other groups to develop those, and they into things like bulky goods warehouses and things like that. They get a very attractive yield on that component of the portfolio. The Australian brick industry is miles ahead of anywhere else in the rest of the world. We're very efficient here, partly because we have such high gas prices. So management's become very good at running brick plants efficiently. Now, the upside for a company like Brickworks now is where the US, they've expanded into the US. Lindsay used to work in the US, so he knows the market very well, and he's dealt with some of these people for a long period of time. And the US brick market is very similar to how the Australian brick market was, maybe 30 years ago, where there's a lot of small players in the market. They've all been consolidated now. Now you just have several big players. The market, there's 38 brick manufacturers in the US, so the market is very different to Australia. Gas prices are very low. As soon as they made their last acquisition in the US, they actually went and shut down 5 plants straight away so they could increase the throughput through the existing plants, because it's quite expensive slowing plants down. So they know what they're doing there. They've got a good market share. I think that they'll continue to consolidate in the US, and the US economy is going well. If you've read recently, they're still trying to struggle keeping their inflation down. Housing's starting to improve in the US, so we think that provides an additional leg of growth for a company like Brickworks. So we're reasonably comfortable with our investment there. It's only ever increased dividends over the last 20 years, so we think that they'll continue to look at ways. They've got massive amount of franking credits on the balance sheet, so they'll only look at ways to return cash to shareholders, because it does produce a lot of cash, this business. You can see from the share price, we started buying these shares around $18, up around $20 now, and we think that over time, they'll head towards $22, $24 and pay a solid dividend on the way through. Johns Lyng is another business that we've acquired recently. Just have a look at the share price. It had a long history. We started buying the shares around $2. What Johns Lyng Group does is it does a lot of remediation work when there's natural events. So if you've got bushfires, for example, they don't do the rebuilds of residential houses, but they do all of the repair work if there's smoke damage or a part rebuild, things like that, and also for floods. So obviously, they've probably come an upgrade in light of the fact that we've had devastating fires, and then more recently, on the eastern seaboard, we've had massive rain and a lot of flooding. So that's all positive for these guys for the next 12 months. The other attractive catalyst, that we look at with Johns Lyng Group is they've made an acquisition of a strata services business, so they go and do all the maintenance for strata businesses. What that allows them to do is get extra smooth their workload. So if there is, pauses in between, doing remediation work for these natural events, you can go off and do repair work for strata buildings and units and things like that. So currently they're servicing about 58,000 strata units. We think it's a very good acquisition. Management's very focused on the business, so should be significant upside in Johns Lyng Group over the next couple of years. So we're quite happy about our investment in Johns Lyng. I think they'll continue to do well. I'm not a weather expert, but it does seem to me that there are more and more natural events occurring, floods and fires and climate changes and things like that, and that all generates work for these guys. Most of their work comes from insurance companies. They're on a panel, and they're probably the only serious national player in that type of business. So things that we sold during the quarter, there's 3 stocks, major positions that we sold during the quarter. QMS Media was one of them. We received a takeover offer for Quadrant at $1.22 a share, in which we sold that into the prior to receiving cash from the bid, so we could deploy the cash elsewhere. You can see, the shares did quite well off the back of getting taken over. So QMS is an outdoor advertising business, which I'm sure will come back to the market in the next couple of years. Collins Foods is the next business we sold. Look, we like Collins Foods. It's had a great share price run over a couple of years, but it's incredibly expensive now. What Collins Foods does, it operates KFC businesses in Australia. It also owns the Sizzler brand in Australia and in Asia, Southeast Asia. And it also, what people are pricing in terms of this being an attractive business is Taco Bell rolling out in Australia, and they've got quite ambitious plans for Taco Bell. Mexican food's quite, it's big in the US. It's gaining popularity here because a lot of it's quite healthy. But that's all priced in. There's only a very small number of Taco Bell stores here, so you're really paying for these guys to execute well. And not all parts of the business are going that well. Sizzler's going backwards in Australia, so we just sort of thought, in light of that, and the high PE that the company's trading on, until they start to deliver, we'll take profits in Collins Foods. The next one we sold was Invacare. To put it simply, we were expecting some margin expansion from their business, and what we actually got was a contraction in margins, even though there was an increase in number of deaths over the period. So Invacare is a funeral business, so we expected them to be able to, and they've done business very well, in terms of adding extra services and things around that whole death experience. But where you're expecting increase in margin, and they've talked about getting an increase in margin, you start to see a decrease in margin. We thought it'd be time to exit out of that position, which we actually didn't work out well for us, and we lost money on that one. So the main things that we got wrong though during the period, we still own 2 of these businesses, and I'll go through these now. The first is Mosaic Brands, which we've held for a while. It's the old 90B business. Management was talking about getting some margin expansion, so not an increase in sales. We were just hoping sales would stay flat. We've reduced the position. They've come out and said they were adversely impacted by the floods, but basically management's whole premise, which made this investment thesis attractive for us, was that they would get synergies below the line, or cost savings below the line, by going out to all their suppliers and asking them to reduce their prices, which would give them a margin uplift. And then they'd use the free cash flow from that to start to reinvigorate the brands in the business. However, they've come out and said they were adversely affected. A lot of their clients and their stores are in regional areas. People have been focused on fires and things like that, so that's impacted. They put out a profit downgrade. We still own a smaller position in the business. It's incredibly cheap. It trades on a forward PE of 7.4 times, and I put that in contrast of where you look at the afterpays and things like that don't produce a profit and are very, very expensive, and which we don't own the afterpay anymore. So it's still attractive. We just need to get some comfort that management can maintain sales at a current level, and we need to wait and see what happens, what their guidance is going forward after the result. And if they've given us some confidence that they can increase sales and that they've achieved some of those cost savings, we'll probably increase the position there again, but it hasn't been a great investment for us over the quarter. Althea was another thing we got wrong. I'm slightly annoyed about Althea. It's a cannabis stock. We've done a lot of work on the cannabis sector, and we think that it will continue to grow. How that pans out, there's two reasons why Althea was sold off. One was the fact that their largest shareholder, Freya Group, which is a business listed in Canada, dumped 20% of their shares. They still haven't made any announcement that they've sold the stock. They're clearly not worried about Australian regulators, and they were just crazy selling the stock down. So they forced nearly halving in the share price of this business, but we think it'll continue to go well. We've exited the position completely, but I do still like the space, and I think if you can pick the right player in that space, you will do very well. But we might have been a little bit early there, and we're obviously frustrated by larger seller dumping 20% of the stock very, very aggressively because they felt that Althea was starting to compete and move in on some of their territory. Thorn Group is another one that cost us during the period. We still own our shares in Thorn Group, and we're reasonably comfortable with Thorn Group. If you talk to management there, if they said the best thing to do for their share price would be for them to delist and then relist, calling themselves a buy now, pay later company. They do offer buy now, pay later products, but they are known more as a traditional financer of things like furniture when you're going to buy a lounge or something like that. So we think that this business is very cheap for the sector that it operates in. It's got good cash flow. We think the business will continue growing. It's a nice time to buy a business like this. I haven't got a share price show that, but it's been sold off very heavily. We think it's bottomed now. We think the business will continue to grow. They've been around for a long time. They know how to operate in this sector, providing consumer finance. So look, we continue to watch that business, but it is very cheap, and I think that will over time start to get valued by the market. And this business really should trade on a forward PE of 15 times or so. So we're there, but it did cost us over the quarter. Maybe we're a little bit too early buying into this business and didn't pick the bottom, but we are still comfortable with the investment with Thorn Group. It's got good management. It's got good control over its bad debts, and we haven't seen how the experience for people like Afterpay and Zip Money will go in terms of bad debts and how they manage those bad debts and the cost of recovering them. So Thorn's an experienced player in that market, very low market cap, and well run. All right, well, that sort of concludes most of the webinar. If anyone's got any questions, I think you can just enter them in on your screen and we can try and answer some of those.